This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 28th, some highlights from today's show. Markets are actually not afraid of tariffs. The Nasdaq is set for further losses, and US PCE data is now in focus. A good day, traders, and welcome. It's Friday, the final trading day of the week and the penultimate trading day of the month. Of course, that does mean we should start to see a little bit of month-end flow come into the equation. Typically what that means is you get a little bit of flattening in the bond markets as we move into that month-end. And we'll talk a little bit about that when we get over to the yields chart and we discuss what's actually happening, which is quite an aggressive steep. Now, with that in mind, we've obviously got just under a half an hour to go now till we get the PCE data out, which will be closely watched, of course. We did have the Fed last week coming out with their usual somewhat dovish tone, telling us they are very much ready to cut rates should the economic environment deteriorate. Now, let's get across onto our first topic of today, and that's very much all about the market and its concerns around tariffs. Now, everything is sort of brace for next week, the 2nd of April, when effectively Trump is going to announce and give us the great reveal as to what the expectations are with tariffs. Now, it's important, of course, to keep up to speed with how the market's interpreting this. And of course, the newspapers are going to write it one way. They're going to always sort of write it as, you know, this could be a panic day, this could be problematic, etc., etc. There's lots of uncertainty and blah, 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 blah. But in reality, we always just want to look at the market pricing. Okay, market pricing effectively tells us exactly what investors are doing because it shows us their positioning. Okay, now the important thing to take away is that we do expect volatility, in other words, a lot of movement in price because everyone's going to be absorbing somewhat new information. But ultimately, if we look over the course of this week, we have had some tidbits thrown at us to sort of get us prepared for what to expect next week. And in reality, the market is really not showing the kind of concern you would expect. Okay, and the best place to look is just look at the euro dollar. Okay, this is one of the sort of currencies that ultimately should be heavily impacted by a 25% tariff on cars, but in reality, if we look across the board, right now the euro dollar is up 3.8% this month, and it's marginally lower on the week. Okay, the point is that the markets are just not showing that sort of concern, and the next best place to look, of course, is to go look at the implied volatility. Now, what you ultimately can see is over the course of next week, early next week, we can see that we do have relatively low vol. Now, when I say low and relative, I mean relative to something like the 10-day average. We can see 10-day average is around that 17.5. So moving into Monday, we can see there's relatively low vol. And then as we get into Tuesday, Wednesday, Thursday, and Friday, the latter half of next week, we see that implied volatility pick up. Now, what that's ultimately telling us is that, yes, everyone is talking about Tuesday and the tariffs, but we can see that implied vol. There is, of course, some positioning, some sort of hedging taking place, but it's not dramatic by any shape or form, because if we just go and look where the 20-day vol is, it's sitting up around that 21 mark. So the point is that the market's not as scared as what the newspapers are making it out to be. And I think this matters because ultimately, should Trump give us what the market kind of expects, what I suspect you will get is a bit of a relief rally. I suspect you will get that sort of, whew, it's not so bad. You'll see some of that hedging unwind, and ultimately we could actually stage a nice rally day on Tuesday. But we will talk a little bit more about that next week. One final thing to note, look where the real implied vol is. It's actually sitting on Friday. Ding, ding, ding. That is non-farm payroll. So the market is kind of more panicked, more concerned about the non-farm payrolls than it is ultimately about the tariffs, and that tells you everything you need to know, which is the market isn't actually that scared of the tariffs. Now, with that in mind, of course, I think yields are an interesting one, and this is not something that I've seen anywhere in Twitterland yet, but we've actually had quite a dramatic steepening over the last 2 weeks in the bond curve. Now, again, I'm not going to go through sort of all the different steepening and flattening moves we've had over the course of the last couple of, sort of months. But I think one key takeaway, if you cast your minds back to December, we had a very aggressive steepening in December, and this was off of the Trump bump. Okay, things were very hot back then. Everyone was talking about tax cuts and Trump is going to make America great again. And as a result, we saw quite an aggressive steepener, ultimately led by the back end. Okay, in other words, the back end yield sold off, back end yield rose quite aggressively, prices sold off, and we got that very, very nice bear steepener on this hot economic environment. Okay, it was a good kind of steepener, a positive kind of steepener. if you fast forward to what we're seeing now over the course of this year, this is not a hot economy type steepener. This is very much a stagflationary type steepener where ultimately the market needs to price in higher yields in the back end because inflation is stuck or set to rise higher, of course ultimately the front end can't move because ultimately the Fed cannot cut interest rates at a time when we do have, of course, higher inflation. So it's very much a little bit of stagflationary type steepening coming into the equation, and this is not the good kind of steepener. This is not the steepener that you want to see. If anything, this is kind of a problematic steepener. What does this all mean? Well, today perhaps nothing, perhaps just a yawn in a moment. We could very easily roll back down and flatten a little bit. Like I said, we're expecting a flattener today, Monday. So I don't expect any further steepening today. I very much think it's going to be month-end flows that will dominate the next two sessions. But early into April, keep a very, very close eye. Should we steepen above that 40 basis points? And again, we are seeing the back end predominantly driving higher in terms of yields. Should we get up to that 460, it's going to add just another problem for the stock market. Now, with that in mind, there was a request yesterday, please do some technical analysis on the Nasdaq. Of course. So yeah, here's the chart of the Nasdaq. Again, whenever I do any technical analysis, I want to know where things are in terms of trend. And I think there's a lot of similarity and eerily similar pattern play to what we're seeing in 22, where we began the sell-off. So we had a couple of months of consolidation in the Nasdaq. We can see we sold off below that purple line, which is the 200-day moving average. We then consolidated, extended lower, came back one last time, tested the 200 moving average, and sold off a lot lower. Now, again, this was also Q1. Okay, if you notice, Q1 2022, the sell-off begun, and it continued into Q2. Okay, ding, ding, ding. Monday is the end of Q1. Very similar eerie pattern here. It's Q1 again, 2025. We had the sell-off. We've come back to that 200-day moving average. And ultimately, this pattern is almost an identical repeat of 2022. When, of course, what happened in 22? Well, we had a Fed that came in and said, guess what, guys? We're going to be hiking interest rates quite quickly and a lot more than what you think. And that was the end of the bull run for 2022. Okay, it's no different this time around. Of course, we're now seeing a little bit of an economic growth slowdown at a time when interest rates are still historically high. So contextually, very much, it does look as though we are in a corrective phase. And this corrective phase is set to stay so long as we remain below this 200-day moving average. Okay, I think that's one of the key proponents of this. If we can't recapture that 20-day moving average and we spend a lot more time down here, so we spend the first 2 weeks down in this area in the Nasdaq, I do expect we are going to see a continuation move to the downside. Okay, and why? What makes me sort of confident, or what changes this thesis? Well, you're going to need this Mag 7 to get its ass off the ground. Okay, right now there is no leadership in the Mag 7, and if there's no leadership, well, guess what? Your Nasdaq's not going to be able to bounce without the leadership. Okay, don't forget, pretty much this entire rally up has been an AI-led rally. And if the AI stocks, if the darling NVIDIA cannot rally, you are not going to get a sustained bull market back up towards record highs anytime soon. Okay, and we can see that again, NVIDIA down 5.5 this week. Of course, we did have that bad news out from Microsoft yesterday. So there just rarely isn't anything good to say around the AI and as well as the Mag 7 in the near term. And that's why I suspect NASDAQ is very much a sell-only market so long as we stay below that 20,500 mark. Okay, if we keep closing below that 2,500, it does open the door, of course, to a continuation. Now, one thing to bear in mind, of course, is the fast money move I suspect is done, and this is where I think 2022 is a very good example. The fast money move's done. Okay, we've had the fast corrective type behavior where the sort of the positioning comes a bit unstuck. Now it becomes a little bit more of a two-way traders market. You can see that. Okay, in this sell-off, it's not like it just sold off in a straight line. It was very much sell-off, bird, sell-off, bird, sell-off, bird, sell-off, bird, sell-off, bird. The point is that the direction of travel is ultimately to the downside, but how it does it is never really going to be that straightforward. And this is what we call a very good traders market, okay? Because it allows you to enter and exit and enter and exit and ultimately maintain a bearish trade view. Now, with that in mind, turning our attention to some sort of more focused levels, I think the weekly candles point to a very interesting dynamic. Okay, again, I don't want to lean on this trend line as anything specific, but we can see now we've broken ultimately that series of higher lows. We can see we broke it in and around that 2,500, which is why I referenced that price. So long as we stay below this, so long as we cannot close above there on a weekly basis, I do think Nasdaq bias does remain to the downside. With that in mind, again, you can see the last 2 weeks, doji, okay, unchanged weeks. And again, I suspect something similar today. I wouldn't be surprised to see that Nasdaq sell off today towards the weekly lows and again close with yet another unchanged week. Okay, more unchanged weeks after a very aggressive sell-off really does tell you nobody wants to buy this stuff. Okay, that's the point. That's why we look at the weekly. It tells us a lot about the sentiment. Now, if we fast forward and look at the daily chart, I think this is going to be a good reveal as to how we enter this short side trade. The reality is we sold off. The fast money moves happened. We then had a lot of value being accepted down below. We tried to gap up. We of course started to fade that back down. But what I expect to see now is a bit more trade in and around the middle of this distribution. So I think anywhere around that 19,400. Don't be surprised to see the market ping back off there and just spend a little bit more time between the 19,400 area and the 20,000 area. I expect quite a bit of two-way trade there, and of course don't forget flows are very much going to dominate the next 1 or 2 sessions. We do of course have a lot to get through in terms of the month-end rebalancing at the start of next week. Okay, and then let's turn our attention, of course, to the PCE. That's the key data point this week. Not really one that I think is going to create a great deal of animosity for the markets. Why? Well, because CPI is just not that important. It's not what it was 2 years ago. We have a central bank that's told us quite firmly that they ain't going to be doing anything anytime soon. Moreover, they've told us their priority is not so much on the inflation data, but rather the economy and the labor market. So there's just not that much expected in the way of PCE. What's a good number today? What's a number that does create a bit of interest? Well, I think any miss is always going to be good. Why? Well, because guess what? It gives the Fed an opportunity to perhaps consider cutting rates a little bit sooner than that sort of end of summer that the market's currently expecting. Okay, beat to the upside, does it change the dynamic? Perhaps brings a little bit of stagflationary concern back into it, which is why I think you get that steepener in the bond curve. So any kind of a beat to the upside, you will expect those long bonds to continue that move lower, that steepener to be a primary play. But like I said, there's far more important things in the market than the PC, and that's got to do with a lot to do with the month-end flows that will start today and of course Monday. That said, of course, the month over month we're expecting a 0.3 print, so just another repeat of the last 2 months. And again, this is not typically a number that misses very often, so there's not a great deal of volatility in, which is exactly why the Fed uses this as their preferred gauge of inflation. Okay, with that in mind, like I said, I think the key sort of summary is that the markets are not really too concerned about the tariffs. We can see the actual volatility that does come through on the days is condensing quite a bit, and so what that suggests is there's going to be a lot more two-way trade. Okay, I think if you look at the last 2 sessions, you were very much allowed to trade the market on both sides, both the buy side and the sell side, and I expect that to be the theme today, as well as heading into Monday, of course, as we get that month-end rebalancing. Now, with that in mind, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there as always. Manage at risk. Go make some money.